everybody. Welcome to Friday of the Talk Money with Tom show. Really happy to have everybody here today. We are here to answer your questions about retirement, retirement planning, how to manage money during retirement, and tax planning and such too. So, if you're 20 or 80 or already in retirement, looking forward to it, a lot of these subjects still matter in terms of what you should be doing to get ready for retirement and what have you too. So, send in your questions. We'll answer them live. If you want to send them in now, you can send them through the email, ask Tom at talkmoneywithtom.com, or put them into chat. Of course, we have this channel. We created this because we feel that there's a kind of a deficit of knowledge in the retirement arena. And so you can go check out our videos. You can subscribe to the channel and hit the little bell button in order to, get the updates as we send them in. Of course, you can also just meet with us if you'd like, ask Ethan and I some questions. We have a book appointment button on the top of our website. The link for the website is on the page here. And you can go in and set up a 30-minute time to meet with Ethan and I and figure out your specific situation. So really looking forward to today's show. I think what happens over the time that we've been doing the show is, I've heard somebody kind of grabs onto one thing, and they really kind of run with it and what have you too. So send in your questions. Feel free to help. We do answer questions that came up during the week in our strategy sessions too, and that seems to help people also. So look forward to that. I always start off the show with a summary of kind of what I saw happening in the stock market this week. And so let me share the chart here. Okay, so this is the S&P 500. I did something a little different here. This is actually weekly data instead of daily. Just kind of smooths it out a little bit, and we can kind of see what's going on. You can see the big run up in 2021 and hit that all-time high at the beginning of 22 and then dropped, and now we're back. We're higher than we were, and you can see. Go ahead.
We finally broke that 5,000 mark.
Yeah, that was nice. Actually, today we kind of opened up above 5,000 2 days in a row this week. Wednesday, Thursday, we just kept going right up to it. We touched it on Thursday. Oftentimes, it's for whatever reason, some of these numbers are barriers. I think because people put in sell orders at certain levels.
It's a psychological barrier. Yeah. You have a nice round number at 5,000. It's a good time to take profits.
Yeah, exactly. And whether it is or not, I actually had a client appointment very early this year. We'd had that nice run up, and they said, "Oh, all my friends are telling me I should be taking profits." And I said, "Well, I don't really play it that way. I usually let things run. I believe in momentum, and when things are running, I might take profits if I saw a lot more weakness before." But it turns out that you were better off kind of hanging in there, right? I mean, look at the line. That's got a little hiccup in that line, but it's pretty straight up. That's a market that is really kind of catching up to where it probably should have been in the first place, because when we go back to what kind of transpired in 2022, high inflation, they're raising interest rates quite dramatically. We had the Ukraine situation also at that time, but which scared people about oil price, which could also impact inflation. But all along, the numbers have been showing inflation is coming down. The Federal Reserve has been raising rates without directly impacting the economy in this particular case, which is very unusual. So it caught people by surprise. And now finally, the Federal Reserve seems, at least at this point, to be done raising rates. We'll see what happens long term, but and even talking about the possibility of lowering rates.
They're waiting for some sort of kind of stabilization of inflation before they want to make any cuts.
Yeah, and that's, personally, I think we've already kind of seen it. If we look at the last 6 months, I don't know that they should be doing a rate cut based on that, so I'm okay with them waiting for a little while. But they do have to, be careful, because last 6 months was at 2% on core PCE, but the last 3 months annualizes out at 1.5%. So again, it'll be interesting to see. The market is still betting on a May rate cut. Was betting on a March one. Now it's not. I don't think May would be a terrible time to do something. I think they do need to be careful. But the problem is, again, this is really important to understand. This Federal Reserve, and especially this Federal Reserve Chairman Powell, they do not want to go down in history as the Federal Reserve that messed up inflation again, like the group did in the 1970s. So what happened in the 70s, the inflation was up, they raised rates a bunch, and then they finally, got inflation to start to come back down. Labor started to get softer, And so that's their other mandate, is trying to have full employment. So they actually lowered rates, and then inflation just got completely out of control.
Yep.
And they ended up having to raise the federal funds rates up to 19%, really at the very end of the 1970s, very beginning of the 1980s, in order to kind of break that inflationary cycle. They don't want to get into that, and I think they're be happier to have us have some type of a soft recession than they would to, be doing, a rate decrease too early. So now, if you look at what's happening, though, it's kind of interesting because the stock market is still running, even with all this worry about when they're going to lower rates, and the market thinks 6 rate cuts, and the Fed says 3, and all that. And the market's got the stock market has other issues that it can look at besides that. The earnings, which have been pretty decent. The momentum of the market, for that matter. The artificial intelligence, right?
Yeah.
The consumer spending. But if you look at the bond market, that's bond market slowed down. We actually have a yellow signal on our bond market right now for the shorter term, mainly because that run that happened with the bond market has stopped as this disagreement between the market and the Fed.
Yeah, rates are actually, I think that it's the second highest they've been since the start of the year. So rates have gone up.
Yeah, as the value of bonds have come down, and what's transpiring there is that bonds have inflation as the or interest rates as the number one issue about those bonds. You can get into quality, but if you're talking about AAA rated and treasuries, which makes up a big chunk of the bond market, you don't usually get into the quality issue per se. And so the real only other issue is the rates.
Yep.
And so we are seeing the bond market slow down because of this argument about rates and when they're going to lower rates and what have you. The stock market is still signaling that it doesn't see recession here. We can see that in this chart. And that's something we want to watch for. So if the Fed leaves rates up for too long and creates recession, that's something that would affect the stock market, because a recession is generally a lowering of the growth of the country to negative for 2 quarters, and there's a bunch of other things. But unemployment's coming up, and so companies are, interestingly enough, one of the reasons we're doing so well right now is because companies have been preparing for recession all the way through this big downturn. And so they've become a little bit more mean and lean, and that's why we've seen the earnings come in. Again, a pretty decent earnings quarter that we're having. Still haven't heard all of them. Still, NVIDIA's right at the end there, or towards the end, so that can be a big one that drives things and such too. So, so this week, a couple things I think are interesting. Number one, it was an article in Bloomberg magazine, which I thought was very fascinating. It talked about, so far this year, every up day is up 0.66% on average, and every down day is up 0.45% on average. If you do a ratio of that, it's 1.5 times better on an up day than a down day. The last time we had that was 1995. Okay, 95 is a really significant year because it was the first year in the best 5 years in the history of the stock market.
Yeah, it was the start of that .com boom.
Yep, start of the .com boom. What do we have right now that's sort of like the .com?
You could say AI is the new .com.
That's right. So, and it was very similar. I was very involved in watching the markets for my whole life here, and I remember 95 very specifically because, first of all, I kept having all these people tell me that it was going to fall apart and that it was too high. It was just the beginning of what was happening there, and so that is also combined with this pent-up demand. This could be a really interesting time period. I just keep shaking my head, and so that I thought that was a really interesting stat, and again, that's a really, really good 5-year period. Things were doing really well. It was easier to make money, that's for sure. You just had to be careful that towards the end, you've got to be able to do something to protect yourself as this thing develops, because it got really nutty, right?
Yeah, and you can think about AI as kind of like a tool that companies will use across the different industries. And so as companies become more and more efficient, they have better earnings results and more profit. And so that's how it drives the entire market, not just the AI sector of the market.
Yeah, I remember hearing from a CEO talking about how the internet at that time was kind of in its infancy, really, and it was great. All these .com companies doing well, but what he was talking about was that the real profits were probably going to become from the companies using the internet. And he was right, dead on right. And of course, there was Amazon. There's companies that came out of that
Yeah.
were .com companies. But you think about the productivity gains. If we had to go back to '95 without the internet, essentially at that time in the function that we see. So it is a big deal, and that's what we kind of see with the artificial intelligence, is that ability to increase productivity, which of course would lead to higher profits, and profits are what drive the markets in the end, right? So, we had the third week in a row with first-time unemployment claims have dropped, and so every week they report how many people are applying for the unemployment for the first time. And continued strength in the employment market is kind of fascinating. I remember we had a jump in the number of job openings. We've had a really big surprise with the number of jobs created, in December that was reported last Friday, et cetera. So the job market is really strong. I think again, the Federal Reserve's dual mandate of full employment and 2% core PCE inflation is going to make it easier for them with that strong labor market to not lower rates as soon.
Yeah, and you can see not every labor market's strong. With tech has, I think so far this year has lost about 30,000 jobs have been laid off, and so you can talk about how different industries have just different kind of where they're in recession or not, or contraction.
Yeah, I remember the chief investment officer for Charles Schwab, Liz Saunders, I believe her name was presenting and saying that last year that factories production was already in a recession. So there's services have been so strong as people shifted over. So that masked the thing, and we've ended up with some overall growth. So yeah, any pocket that you get into, you can find good or bad, right? So we generally talk about the overall, mainly because we invest in the overall. We buy these type of indexes. It is tech heavy, that's for sure. But that's what's happening. So it keeps on going. So another article talking about how if you have a positive January, we had a very good January, and you have a positive February, we're in the 9th day, so we got a ways to go, but it's really good so far. If you have two good months at the beginning of the year, 100% of the time that's happened, we've ended up with a positive year for the year, and the average rate of return for that year was 24%. So it's just stacking up. We got the Zweig breadth indicator, we've got this ratio of positive days to negative days that's as good as 95. We've got this possible 2-month start that is has been a good thing in the past, and again last year everybody's asking us what do you think about 2024? Well, I mean, we keep getting all of these pieces coming out historically showing. And one thing I will say as a caveat, that there's what I call the outside influence. That means something crazy happens someplace, could knock everything off, right?
Yeah, the black swan event. You never see it coming.
Yeah, exactly. So that's always out there. And my biggest thing I think about is some just giant international event of some type, China and Taiwan or whatever it might be, that would scare the market off of these things. But if you kind of can discount that at least somewhat and ignore that, and you look at the basics of what's happening economically, what's happening with the leading indicators, what's happening with the actual chart pattern, I mean, just look, things are lining up to be really good for 2024. So very, very nice week. Again, we're bound to slow down. This is a crazy stretch, even for a 1995 type run. If you look back at 95, it had some periods of time that it comes down. I remember after the pandemic in 2020, we had a heck of a run all the way up until the end of 21 in the end, right? Because of all the money that was put out. But even then, we had a couple 10% drops, had like 2 in a row, actually, September and October of 2020. And so that, be aware, that's normal. As a matter of fact, in this run that we're looking at right now that started in October of 2022, we had that 10% drop, end of July to the end of October last year. So still great market. Even in a great market, you're going to have 10% drops. That's just kind of how it works. So that could happen. But keep in mind that the momentum is still there, and the money that's coming in is obvious to me. I mean, you can see it. I mean, even on days I wake up and you look at the market opens up, and okay, and it drops, quite a bit, and then it'll kind of work its way back up. Still might be negative for the day, but it came back 0.5%.
Yeah, a lot of times we've seen like the market kind of starts off, but towards the end of the day shows some strength.
Yeah. And today's thing that the market was waiting for was this. They revised the CPI. So CPI for December was revised. It was actually slightly lower, right? But pretty much the same. It was really just lower on top line inflation, which is not something the Fed looks at that much. And the actual CPI for January comes out in next Tuesday.
Yeah, there's some fear of what happened last year where they didn't count used cars and automobiles or new vehicles as much, and so there was a revision up, and people got worried about that.
Yeah, exactly. So it's usually a non-event, to be honest, but in this environment, it's something that they look at. So anyway, that's our summary for the week. Another good week. Good time to be an investor. It's a good time to kind of look at what's happening. Technology is doing quite well in this particular run. Semiconductors, cloud computing, cybersecurity are three big areas that we have that have done well, as far as that goes. So it just kind of continues to move forward, and enjoy the ride. It's got to have some upside to go with the downside, and this has been fun so far. We'll keep watching and see what happens here. But anyway, look forward to going over this again next week. All right, what do we have for our first question?
So this question came in during the recap. Why do you think growth is running so much better than value today?
Ooh, well, it's not just today, even actually, just overall. It's been a while since value has really dominated for more than a month or a quarter, in my rough opinion, and so growth has been the big story. I just think growth, I don't know, it's just in favor in terms of a concept of what you want to invest in. So when you look at growth, these are companies that are growing rapidly, and people like that. They've got technology and products and things that people really want right now. A value stock, it's in a couple different categories. Number one, a company that's in trouble, like an AT&T was in trouble for a while, and restructuring and what have you. GE, dropped 90%, from its high. And so, it was in trouble. And the idea there is, hey, I'm getting it cheap. They're going to turn it around. I know I've been accumulating Target, which is down 30%. I just saw that today over the last 3 years. But, so that's a value play. I've been kind of dollar cost averaging little bits into it because I just feel like it might come back around. It's just on a personal basis. But it's down 30%. So that's one of the issues with value. It can continue to go down.
Yeah, value tends to do better when interest rates are going up. Growth outperforms when interest rates are kind of stagnating or going down.
Yeah.
And so today's news, basically CPI not having much revision, is kind of a good sign for that interest rates won't go up. And so that's why growth runs on that news.
Yeah, exactly right. And that's it's really fascinating to watch, all of these different dynamics as far as that goes. The other part of value that is just that companies that are kind of cyclical, like energy tends to be a value play quite often, right? And energy can do very well at periods of time. Certainly 2022, if you had energy, you did well. I think it was up, substantially altogether versus the market being down. So, interest rate increases are not friendly to the growth type stocks. And so when interest rates are flat now or going down or might be going down, you're going to see a run in growth stocks.
And also, value people tend to move towards value when they feel the market's kind of contracting, or they think there's a recession pressure. But as recession pressure kind of dies down, growth tends to run more too.
Yeah.
And right now, consumers very kind of not expecting a recession for a while.
I guess though I'll say one thing. I think things changed in 2020. 2020, we locked everything down. Nobody could do sports betting. We had Robinhood. We had all these things. And we got this group of people in, all very excited about really growth type stocks, solar, clean energy, genomics, the future, right? And they started using, options where they could make an outside influence with a fairly small amount of dollars. And when they did a lot of options, these big brokerage firms had to buy those, and we saw ginormous run-ups in all of those areas. And it's just a group that kind of likes that. And I think there's still a big influence there from this group that, so when we do have a drop, they keep coming in and buying it. I mean, they're that's a little bit like Bitcoin. They basically are just really holding in there, right? And they're going to hold in, and they're going to buy it when it drops and that type of thing. And we're seeing some of that same stuff, I feel, in some of the tech areas. And so it's like a different group that normally wouldn't have this type of impact because they're smaller investors. But because of the way that they're using options, they're basically magnifying their money maybe 10 times the value. Put in, 10,000, it's like buying 100,000. Because most of the market is dominated by the big players, the pension, mutual fund, hedge fund managers, and such do. But these smaller players have made an impact. You can see it. And they're doing it, I wouldn't do it that way, but they're, because it's really crazy.
There's just an ease of investing now.
Yes.
It's a lot easier for anybody to get in and set up an account and
run. Sit there on your phone and, you got $0 transaction deals and what have you, and you can take smaller amounts. And, momentum investing, I think, is popular within that group. I think that's what's happening. That's certainly what was happening in 2020. So anyway, it's a good question.
What are the landing scenarios, and what does each of them look like?
Landing scenarios for the economy. So we have, hard landing, which is a big recession, soft landing, which I guess would be a slight recession that you might not even notice, and then no landing where you don't have anything. So far, I don't know, it's kind of weird because we had 2 quarters of contraction, I believe, last year, which is part of the definition of a recession. There is a group, I can't remember the name of them now, that specifically determines whether we had a recession. Of course, they tell you about 6 months after it starts. It's kind of a weird deal. But if you really look at, the different scenarios, so hard recession, think 2008, right? That was a hard recession. Companies going out of business, unemployment going up quite a bit. And that type of thing, earnings dropping, markets dropping pretty heavily,
so you can
in that time frame.
Kind of like an 08, or it could be 04, or 2000, I mean, but like something like pretty significant.
Yeah, and so a soft landing still be considered, I believe, a recession, but nonetheless just a slowing. And that's what they were talking about from the beginning. I will say Chairman Powell and Janet Yellen, the Treasury Secretary, both were saying that and from the beginning, from November of 2021, they felt like they could raise rates in this environment and still achieve a soft landing, mainly because they saw such a strong labor market happening at that same time, and felt like maybe some of the inflation would be transitionary, which is a bad word now, apparently, but it sort of has been transitionary. It just took 3 years instead of 3 months or whatever it might have been. So because they're right. I mean, the supply was restricted because people weren't at work and, we couldn't get the goods and those type of things. And that supply has gotten to be better and better as the pandemic has faded farther away. So that's where, the economy kind of slows. And they were talking about maybe like a 1% growth on GDP for the year was what Powell talked about. And then, of course, no landing is I don't know what we're doing now, where it's just going. We just had 4.1% growth in the second half of, annualized growth the second half of last year on the gross domestic product. The stock market's doing well. Unemployment is very reasonable for, historical standards, if not really good. And, all those pieces that are there. There is more talk about a no landing scenario than I've seen. There's still a big group that believes recession. Some of the big indicators that predict recession are still negative. The inverted yield curve, which is very, very accurate historically, has been inverted now for almost 18 months. I think it got the one that Powell really looks at is the 3-month 10-year, and that got inverted in October of 2022. And so, that's like 15 months. The average is 12 months from inversion to recession start. So, but that's an average. So it could still happen, right? the people that were talking about recession last year could still be right.
Yeah.
They just might have been wrong by a year or what have you. So, we'll see what happens there. Um, I think personally, when you look at this pent up demand from the pandemic, that's offsetting the recession. We should be in a recession already. We're not, because we had a pandemic and we pushed out a lot of money, and people are spending that plus more.
Yeah.
Credit cards, whatever they have, they're spending. I have clients talking about doing revenge travel this year, where they're basically getting out there and wanting to travel a lot more this year. It's just picking up. And so that's how the Roaring Twenties got started. The pandemic finally got over. It took a while, and people just got on a roll. Pretty soon that became sort of almost like a mania, just the feeling and such too. So I've been saying for a while, we have both the pent up demand that created the Roaring Twenties and the AI that created the .com type scenario together for the first time, maybe ever. Those are pretty powerful upward forces that are going to drive these things. So that no landing scenario is definitely possible.
Yeah, and so basically all these scenarios have inflation going down, and it's how the economy kind of reacts
Yeah.
to that,
Yeah.
just the elevated interest rates.
Yeah.
And so, a couple of years ago, we were debating, are we going to be a hard landing versus a soft landing? Now the debate's kind of shifted to a soft landing versus a no landing scenario.
Yeah. Yeah. I will say I've studied the economy and the markets for my whole life. Anything can happen.
Yeah.
You got to be really careful with really locking in on, where we are at the point right now and extrapolating straight up or straight down from that. Because, in real life, anything can happen. And so you want to have a system kind of like we do. We have 181 ETFs on our list. They float up to the top. We want to buy those. We're buying those waves as they come up. As they fall back down below our cut line, we're selling those. These are in our targets, And what happens then is that, if value starts to do great instead of growth, value will move up to the top. We'll be moving out of growth and into value. If, T-bills start outperforming everything because the market's falling apart, then we'll be in T-bills for that period of time. So we have a system that's designed to kind of deal with this. Because what happens is you can make a projection and say, hey, we're going to have the greatest boom in the stock market ever. I'm buying, I'm holding, I'm going to keep on buying, I'm going to keep on buying. And I'm going to end up with bingo.com or whatever that goes out of business, So you really got to be careful with that projection. Just react to kind of what's happening with the market and just keep going. And, the market is way ahead of what we're talking about. Believe me. If we start to see deterioration in the market, you'll start to see that on this list. This list is incredible for me because it kind of can see what's popping up to the top and what's moving along and what's driving this stock market is there. And, sometimes it's just mind-boggling. It's like, why are these things doing well, because it's supposed to be a growth tech arena and all of a sudden they're not. And, so that's how that's an important point of this also. All right. What do we have for our next question?
How do you keep investing when you feel the market is expensive? Because of this big run up, stocks are kind of expensive to their earnings.
Yeah. It can get a lot more expensive. I actually don't put a lot of emphasis in the PE ratio. I've just learned over the years, the PE ratio, that looks really cheap. It can get a lot cheaper, a lot cheaper. In that downturn in 2008, that unwound over about a year and a half period, and the PE just kept getting lower and lower, and so you were trying to basically catch a falling knife if you were trying to buy that. The opposite can go the other way. 1995, I kept hearing how expensive it was, and man, if you'd have bought in 1995 and managed that money well, by the end of the run there in end of 99, you'd have made some awesome money.
Yeah.
So I don't really look at it that way because it hasn't panned out. I mean, if you look at it very long term, and you're willing to be a 30, 40-year investor, you can make some arguments for, just accumulating under certain PE ratios. If it gets under 13, you just accumulate. It might go to 10 or 9, but whatever. But the problem is that, first of all, in the investing world that we're in, clients give us maybe 3 months, not 30 years, and so there's got to be some performance results that are coming out on a fairly regular basis. So it depends on your tolerance for time. But Uh, I think personally, dollar cost averaging is always a decent concept in my world. But be careful. I'm more concerned about the stretch of the market,
Hmm.
the relative strength indicator, the
Yep.
Wilder's relative strength indicator on a 7-day basis. When that gets above 70, I get nervous about putting new money in. Um, and we'll often hold off when new money comes in until it gets below 70, and then we'll start accumulating. We did that just, at the end of last year. As
Yeah.
I recall, it worked out okay. But and it's above 70 right now. I think it's 72.6 or something like that. So definitely a little stretched out. However, this is a weird scenario. I'm telling you, this could stretch out and stretch out and stretch out. You could be sitting there waiting for it to get below 70 for quite a while and really miss out on a pretty good run.
Yeah.
I mean, we went back today because we had this question already. It got to a little over 80. I think 82.
In December, right?
Yeah, December 19th, right? And so you would say, oh, that's just too high. I wouldn't buy there. And we didn't actually. We waited till it got below, and it did.
Yeah, a slight pullback.
Yeah, a slight pullback, and we bought, and that worked out better than buying it at 80. But if you'd bought it at 80, you'd be really happy right now.
You'd still be good.
Yeah, you'd still be up a lot. So sometimes certain markets get such heavy momentum to the upside. You need to ride that. Even if you're wrong and it pulls back, okay, great. But you might be right. And these types of opportunities don't come along that often. So I wouldn't be too nervous about this market the way it's sitting right now because the momentum is so good. And because there's some fundamental reasons why this market's moving. It's not just, some crazy thing. The Federal Reserve has stopped raising rates and is now actually talking about lowering rates versus, just hammering the market verbally, for the last, almost 2 years. So, I think that there's some catch up to do here. The market probably shouldn't have even come down. If you look at, there wasn't a recession. Why is the market coming down in 2022? It shouldn't have. And I think that's the realization now, especially if we have this no landing scenario that they're talking about, that, hey, the market should be higher already. Because if you look at the normal trajectory going back, say 20 years and draw a line on there, got to catch up to that trajectory. So anyway, that's it's a good question.
So what's driving the market right now? Is it like economic and inflation news, or is it kind of the earnings reports? Because we've been seeing like a pretty strong market for the last month and a half.
Yeah, let me share my screen here. We'll take a look at this. This is from YCharts. This is the core PCE price index, right? So PCE is the favored basket of inflation goods that the Federal Reserve uses. They like core. Core takes out food and energy. When they're talking about getting down to 2%, this is it. And we're at 2.9, right? Year over year. So this is, as at the end of last month. End of December, actually. And so when you look at this and you look at the stock market, they're inversely related. This little peak that happened here was in September of 2022. Market bottomed October 13th of 2022, and inflation has continued to come down. And what has the market done?
It's gone up.
Yeah. Now, didn't go quite up as straight as that thing went down. It's nice and smooth. Lots of ups and downs and hiccups, because you have this weird dynamic right now where there's these two big groups with lots of money battling it out. One group thinks that inflation is the biggest issue. The other group thinks the recession is the biggest issue. And they're actually the opposite of each other. And so that's why you get this kind of volatility. And I think, the recession group has essentially thrown in the towel right now, and that volatility has disappeared because the inflation group is running the market, and this is what they're seeing. And we talked about this before. This PCE, if you take the last 6 months and annualize it, it is at 2% already.
Yep.
If you take the last 3 months and annualize it, it's at 1.5%. So, we're already there, and this is the main driver for the stock market, and even the bond market to a certain degree is riding on this thing. And I think the bond market is going to have a little bit of a different scenario because the Fed, they're humans, they're not machines. They may not be lowering rates as fast as they should be, or at least the markets thinks they should be. So we'll see what happens there. But there's a direct correlation here, inverse correlation. As inflation has come down, the stock market has continued to move upward. And so I think of all of the factors, earnings in the end are the main driver. There's no doubt. So many studies show that, earnings growth is what drives the market. As a matter of fact, it's what you invest in.
Yeah.
Because, if I invest today and 10 or 15 years from now, those companies are making more money. My stock probably will gain value because of that. And it's one of the main reasons that stocks tend to keep up with inflation, because companies, charge more when there's higher inflation, and they tend to have margins that grow and such too. So anyway, that's it's a very important component. But inflation and the Federal Reserve's dramatic impacts of high interest rate increases can affect earnings normally. So,
Yep.
Normally you raise rates 5%, you have a recession. I would say I haven't done a study on that, but I bet you that's close to 100% historically. And so, no recession this time. And so that's the surprise. Market did drop because this is what normally happens, but we don't normally have pent-up demand from a pandemic sitting there. That's the difference. It is the driver. A pandemic was a horrible thing, but it helped the stock market because of all the money that the government put out. And now it's helping because people are spending more than they were before, just because they're so happy to be out doing so, going to restaurants and going to the malls and traveling and all those types of things. So I would say the number one driver, though, and the thing to still focus on, and we saw it this week. The market it got to 5,000. That was part of the barrier, but the other barrier was this Friday, today's adjustment that they were going to make on the CPI, and then the market jumped through the 5,000 when we got the number before the market opened that the adjustment was a non-event, and the market takes off. And then I bet you next week, we got the CPI on Tuesday.
Yeah,
right?
Tuesday will be a big day.
Yeah, it'll probably be sitting around on Monday, waiting and, that kind of thing. So, and it'll still react to that. So I think if you watch kind of that action, there's a lot more action that's more definable to me about inflation than the earnings as far as that goes. So, yeah.
So, what factors would someone look at if they were deciding between a Roth 401k versus a traditional 401k?
So a Roth 401k, you put the money in, you pay taxes on it as you put it in, and it then grows tax-free.
Yep.
A traditional 401k, you put the money, let's say it's 10, just make up the number. 10,000 goes into a Roth. You pay $2,000 out of pocket to put that in there, and still have 10,000 in there, and it grows tax-free. If I have a traditional IRA, 401k, I put that 10,000 in there. It's technically a write-off. It doesn't show up as income, so I don't have any taxes on that money. I'm delaying my taxes. It's tax-deferred vehicle. And so, what are the kind of pros and cons? It's sort of like, when do you want your gratification? So if you like your gratification now, not having to pay money on that 10,000, then the traditional 401k tends to be the thing, and people do like that. Even when I talk to people about the advantages of a Roth 401k today, they still really like that constant, tax deduction, and don't want to have to pay taxes on that, that money going into the Roth. But we are on the other side. We deal with the retired. And you can see the problems with the big money in tax deferred accounts.
Yeah.
Yeah.
For me, it's a lot about looking at, what stage of you in your career. So, if you're early stages, I think Roth 401ks are great. I think once you start to hit certain tax points, once you start to push past that 24% bracket, that's when I think a traditional 401k is advantageous. But to take advantage of that, you have to have a lower tax bracket when you're pulling the money out. If you're going to have the same tax bracket, you could say they're equal, a traditional versus a Roth, if you were to have a continuous tax bracket throughout your entire life.
Yeah, I think if you run the numbers, when you're in a high tax bracket, you're going to be better off putting money into a traditional 401k. But there's some other things besides the numbers that I think have to be considered. There are two that jump out at me. Number one, if I was going to do a traditional 401k, I'd be wanting still to try to convert in my lower earning years at the beginning of my retirement to convert that to a Roth IRA. So one thing to keep in mind is that they have changed the conversion rules multiple times, and had periods of time where you couldn't convert if you had a certain amount of income. And so the conversion was really, really limited to the point where we didn't even talk about it.
Yeah.
And now it's unlimited. So that's why we talk about it all the time. So I got to be careful if I'm going to, use this strategy and say the last 15 years of my working career, because I'm in a high income, I start doing a 401k traditional because I'm going to convert it over afterwards. You may or may not be able to. So yeah, be a little careful there. The other thing is that's really important is I have situations in my practice where two people were working, they were both contributing to traditional 401k, tax deferred, and then one person passed away. And what happens is now you've got one person with basically a double amount of 401k than they would have had on their own. And the IRS doesn't give you any break on that. You're still a single filer with lower tax brackets. Your requirement of distributions are higher. Your means testing on Medicare is higher because you're single instead of joint. You get hosed.
Yeah, essentially your RMDs double, but your tax bracket halves.
That's right. Your tax bracket halves, your RMD doubles, and your Medicare brackets. I don't know if they half, but they're not as good as joint, and so you get hammered. So you got to be careful there too. So let's say both of your last 15 years were in a high tax bracket. We're going to pound money into this traditional 401k, take the tax break now. Once we get to retirement, we'll start to do those conversions. We're going to convert at certain tax brackets to try to, make it work. But then one of you passes away, all of a sudden the other one has all that money and they got half the tax bracket. We can't convert as much. And so again, these are things that, these are real world situations that may not be obvious when you look at the numbers, but they're just from experience of, dealing with, the one thing about somebody like us is we've walked through, we have clients from 20s to 90s. Yeah. And so we've walked these paths with all these people. Even if they just became a client when they were 70 years old, we still know their path. We saw how they got to where they are. And as we participate with them going forward, we get to see, intimately the path and what was good, what worked, what didn't work. And the Roth 401k and Roth IRA in the end, they're really, really powerful vehicles because you could get to a spot where you still have a tremendous amount of money in a Roth and you have no other real taxable income. You could even have your Social Security be tax-free, depending on situations and what else you have and what other incomes and what have you. But you could have a situation where your Social Security is tax-free and you're paying the least amount you can pay for Medicare. Now, it's kind of painful to get there because you have to pay the taxes on that money to get it into the Roth somewhere, either off of each paycheck if it's a 401k or if you're doing conversions, every time you do a conversion, you're paying money. But if you look at those numbers going forward, assuming you live, right, which is always a question mark, that's an issue, but the payoff is pretty tremendous, and you could have a really fun retirement,
Yeah, and there's also arguments that if you're later in your stage of your career, let's say you've had a large 401k, just a traditional 401k that you've already built up throughout your career, maybe you can start to think about doing Roth for a portion of it then.
Yeah.
Because once you hit a certain age, you have to take RMDs.
Yeah.
That's no matter what. And so trying to control that RMD, because you want to match how much you have to pull out of your IRAs to how much expenses you have. You don't want to be taking too much. And so that's where RMDs get onerous.
One huge caveat here that's really important. This probably applies much more so to $1 million plus scenario than it does to say $100,000 scenario. If you have $100,000 in the end in a 401k or I'm making that up, but less than $1 million, it doesn't make as much impact, right? You can go either way a lot easier. What we're dealing with a lot here in this valley are these very large 401ks, mainly because these companies match. Some of them match 100%.
Aggressive matching
for competitive purposes to try to attract these employees. And so that's a first world problem, believe me, and my 401k is too big. And so, but it's a challenging problem to have in terms of trying to figure out how to maximize that and maximize that for the whole family, even the beneficiaries too. So So anyway, keep that in mind when we're talking about these things. We're generally talking about. So if you think you're going to be in that boat someday, listen closely to what we're talking about here. And for most people that are retiring, and saving aggressively, they'll get a pretty good size 401k,
Yeah.
especially with the match. So it does make a difference. Okay, well, that's our show for the day. I want to thank everybody so much for coming today and sending in questions. You can send those questions in again during the week. Send them to asktom@talkmoneywithtom.com. I'll be happy to answer those and go through, the answers to help you with your retirement. And then, of course, you can subscribe to our channel. Hit the subscribe button, the little bell button to get notified when we put new things on there. And then lastly, of course, if you want to, you can meet with us and have a half-hour appointment, phone, in office, video, whatever works for you. Kind of ask us specific questions for your situation, and we can help you too. So, lots of experience here at dealing with some of these things. We might be able to, give you some advice that would be useful. So, look forward to being able to see you again next week. And thank you very much for coming today.